day. Thank you for joining me. Today I'll take you through Roche's FY20 results. On the 4th of February, Roche released its FY20 results with the following key highlights. Pharmaceutical sales were down 2%, led by a continued strong sales growth of newly launched medicine. This was largely offset by the impact of competition from biosimilars. Moving over to the diagnostics. Diagnostic sales grew by 14% due to COVID-19 testing kits. This was more than offsetting a decline in daily routine testing due to the pandemic. Overall, the group revenue was up by 1% for the period. Core operating profits as well as core EPS decreased by 4% and 4.9% respectively. The group declared a final dividend of 910 Swiss franc, reflecting a 1.1% increase year-on-year. For the full year 2020, operating free cash flow came in at 14.8 billion Swiss franc, despite higher investments in licensing as well as higher inventories. Following the results released on the 4th of February, the share price firmed 2.15%. Since our last overweight recommendation on July 2020, the share has declined by 8.6%, while the benchmark has surged by 18.9%, with the sector index up 6.3% over the same period. On an earnings basis, EPS estimates have been on a slow downward trend since our last overweight recommendation. This is largely due to the impact of COVID-19 on products that rely on hospitalization and outpatient visits. As lockdown lifts, the market expects EPS to improve in FY21 and FY22. On a forward PE basis, the group is trading at a 1.2% premium to its long-term average of 14.9 times and at a 19.6% premium to its FactSet peers. The group is currently facing one of its industry's biggest patent expirations, yet it's still managing to grow. Basing off FY19 sales, about 40% of pharma sales were at risk of biosimilars, with more headwinds faced by Avastin, Herceptin, as well as Protesan. We project that the pandemic could further drag down the growth pace because of the heavy reliance on physician-delivered drugs. However, diagnostic division has significant potential of sales of the COVID testing kits. Both the group guidance and the consensus view of erosion rates were too optimistic in our original analysis, but we have since revised our view on the stock, and thus we lower our overweight recommendation to neutral as we see the company growing below its counters over the next 3 years. Should you wish to place a trade with us, please take note of the following personnel. We would also like to draw your attention to the following disclaimer. Thank you.